Hello traders, welcome to the Simply Trade YouTube channel. So we're going to be continuing from where we stopped. I promise you guys that we're going to be looking at a teaching series that covers the smart money concepts, and basically we're going to be focusing on technical analysis. So it's going to be an in-depth explanation to the technical perspective of the smart money concepts. And as we transition, we're going to look at the advanced perspective to that. But we are beginning with the very basics. So we're starting with the basics. In the last lesson, we discussed about the identification of valid institutional pullbacks. In this episode, we're going to be looking at market structure, but we're going to be looking at market structure from the very basic perspective before we transition to looking at market structure from an institutional perspective. So what you can see here displayed on the screen is basically the types of market conditions we have, or market structure. So we have the bullish market condition, and then we have the bearish market condition. And also we have what we call the sideways market or ranging market condition. So, they always tell us that the trend is your friend. That is why you see most traders basically focus on trending market condition. So the trending market condition is the bullish market and the bearish market. This is a sideways market condition. It is not trending. It is not giving us a movement to the upside, meaning a sustainable movement to the upside or a sustainable movement to the downside. So the market is just moving upward, downward, upward, downward. So it's not giving us what series of rise in price or drop in the price. So the market is dropping and rising, dropping and rising, dropping and rising. So that is what a range bound market, a sideways market. So this is a bullish market condition, and also what we call the uptrend. So a trending market is made up of the impulsive movements. So in a bullish market condition, the impulsive movement is the movement that is towards the upside of the market movement. So that is the impulsive movement, or what we call the expansive movement. So market condition is made up of the expansive movement and also the corrective movement. And the corrective movement is what we call the retracement, or what we call the pullback. In a bullish market condition, the impulsive movement is the movement towards the upside, while the retracement movement or the corrective movement, or what we call the pullback, is the movement in the downward direction. So it is the movement that is against the impulsive movements. It is the movement that is against that particular trend. That is what is called the retracement, the pullback, or the corrective movement. The impulsive movement or the expansive leg movement is the movement in the direction of that market movement. If the market is bullish, so when the movement is giving us upward direction, then that is the expansive leg movement. When the movement is against the upward direction, that is the pullback movement. So we have the impulse, and then we have the pullback. We have the impulse and we have the pullback. I must understand that the trending market is made up of swing high and also swing low. So here we have a high, and when the market pulls back, it creates a low, and then it gives another expansive movement, taking out the previous high points, meaning price broke the previous high points, and now it creates a new high, which is now a higher high. It is a higher high because it is higher than the previous high points, and then price gives the retracements, and then creates a new low point. But the new low point is a higher low because it is higher than the previous low points. And then we have again an impulsive movement to the upside, breaking the previous swing high point, breaking the previous higher high, creating a new high, which is now a new higher high. So this is a new higher high because it is higher than the previous higher high points. And now we have a pullback to the downside, creating a low, and it is a new higher low because it is higher than the previous higher low points. So you can see in an upward movement or in a bullish market condition or an uptrend, we want to see price breaking the previous high points. Then that is when we are bullish. That is when we are in an uptrend. So we want to see the market breaking what? The previous swing high points. And here we are in a bearish market condition. The impulsive leg movements in a bearish market condition is to the downside. That is the impulsive leg movement, is to the downside. And then the movement that is towards the upward direction is the pullback movement, or what we call the corrective movement, or what we call the retracement. So this is the impulse, this is the pullback, this is the impulse, this is the pullback, this is the impulse, this is the pullback, this is the impulse. And then in a bearish market condition, the market is giving us what? Lower highs and lower lows. While in a bullish market condition, it is giving us a series of higher highs and higher lows. So what we can see here is price give us this high, and then we have the drop creating a low point, and then the pullback creating what? A high. This is a swing high, but then it is a lower high because it is lower than the previous high points. And now price gave an impulsive movement, breaking the previous swing low points. So it means that in a bearish market condition, we want to see price breaking previous swing low points. That is for a bearish market, a downtrend movement. And then price gave the corrective movement. That is the pullback. That is the movement against the trend. And now we have the impulsive movement, breaking the previous low points. And then this is a lower low because it is lower than the previous low points. So in a bearish market condition, you want to see the market breaking what? Previous swing low points. In a bullish market condition, you want to see the market breaking what? Previous swing high points. So I believe that is clear. So we have a bullish market trend, and then we have a bearish market trend. Or we can say we have a bullish market structure and then a bearish market structure. So we are looking at it from the basic perspective. We're going to transition into looking at it from an institutional perspective, how to map out ideal institutional market structure. So this particular market condition we have here is a sideways market. So what you can see, the movement here seems to be going to the upside, but then price pulled back, pushed to the upside, failing to take out this high, and then fell again back to the downside, taking out this low point. Price again pushed, taking out the high point, fell to the downside, failing to take out the low, pushed to the upside, failing to take out the high, fell to the downside, failing to take out the low, pushed to the upside, taking out the high, and then price again fell, taking out the low. So you can see the market is just within a range. So it means it is within a resistance and then within a support level. So price is just bouncing off from the resistance and also bouncing off from the supports. So it is not giving us a trend. The price is not just continuously rising or continuously falling. It is rising and falling, rising and falling. So this is the basic understanding of market condition. So we are going to transition to understanding it from an institutional perspective. So this is what we have. This schematic is just used to explain to you how to identify market condition. We're going to look at the chart to practically see how you can identify and map out the structure from a basic perspective. So let's use the real-time charts to look at how to identify market condition. So, this is just the basic perspective. We just want to be identifying swing high and then what? The swing low points, which helps form the what? Higher high, higher lows, lower high, lower lows. So what we can see here, this is a downward trend. That is a bearish market condition, and we can see here the market is trending to the upside, bullish to the upside. So we just want to identify basic structure, just the basic structure. As we transition, we're going to look at identifying what structure from an institutional perspective. That is where we'll start dealing with understanding of inducements, the major inducements, the minor inducements, basically understanding what liquidity entails. That is what we are going to be looking at, because liquidity plays key role in identifying institutional structures. So what we can now see here from the chart is we have this bearish market condition. So let's look at that. So this is a high point, this is a low point, and clearly what you can see is that the market went to the downside and then broke this low point. So price broke this low point. This is a swing low that has been broken by this movement to the downside. So if I should ask you, where is the impulsive movement? This is the impulsive movement, because this is the movement that aligns towards bearishness of the price, the falling of the price to the downside. So whatsoever goes against this direction is the pullback. You can see that our direction is what? It's to the downside. So whatsoever goes against the downward movement is the pullback. And then whatsoever aligns to the downward movement is the impulsive leg movement. So what we now have here is we have the impulse. Now we have a pullback. So it means that price has given us what's here? A high. We have a low here that was broken by the impulsive movement to the downside. Price has created what? A new low point. And this is a what? Lower low, because it is lower than the previous low points. And now price has given a pullback, creating what? A high point. So this is a lower high because it is lower than the previous high points. You can see it is low. It is a high, but then it is low compared to the previous high. So you can see we have swing low, swing high, swing low, swing high. So for us to have the sustenance of the bearishness, it means that price also should break the next or newly created low points. And what can you see? Price gave another impulsive movement to the downside and then broke the low points. So you can see that we are what's still sustaining that what? Bearish movement of price to the downside. So what we can now see is looking at it from just the basic perspective of structure. Where is the newly created high points? This is the newly created high points, because this is the impulsive movement that took out this low points. We have price what formed a new low here and then a pullback, and then price fell. But what you can see is that price gave us a movement again to the upside, taking out this, but then price again continued bearish to the downside. So it means this is the low point of this movement, this high. This is where the low has been fully established. So once you look at the institutional market structure, how to map that out, you get to understand it. So it means this is the entire impulsive movement from this high to this low point, because this is now the valid pullback that has created a new high that further went bearish, creating an impulsive movement again to the downside that broke this. So it means that we have a break of structure to the downside. So price has broken what? The newly created what? Swing low points. So what am I trying to say? We have our newly what? Created lower low points, and then we have our what? Lower high points. So price again created another pullback, creating a new high points. So since price created a new high point, it means that price broke what? The next low to the downside. The newly created what? Lower low points. So price broke through that. So we have what? The low here created. Price has given an impulsive movement that has broken it. And then what can you see? Price created a new low and created what? A new what? Lower high points. And then an impulsive movement that has created a new what? Low point again, which is what? A lower low. Are we together? Meaning this low broken to the downside. So you can see the bearish market condition. So let's look at that by using this annotation of it. You can see we have 4, that is the impulse. We have what? A pullback. We have what? A push to the downside, breaking the previous low. We have what? A pullback. We have what? A push to the downside. We have what? A pullback. A push to the downside. We have what? A pullback. A push to the what? Downside. So you can see we are bearish. So this is what the bearish market's what? Condition. Price giving us what? A high, a low, a lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. I seen it. So this is the basic structure. I must understand that within a structure, there is also another structure. So we have what? The major structure, and then we have the minor structure. So we are going to look at that as we transition to the understanding of market structure. So I just want to show you the basics to identifying structure. Because what you can see here, within this impulsive leg movement, we also have price fell to the downside, gave a valid pullback here. If you can remember what I taught you about pullbacks, you can see this movement to the upside, went to the upside, took out this high point. So that's a valid pullback. And then again, it fell to the downside, a valid pullback again, and then fell again to the downside. So this is a major structural narrative we've identified. But within this major structural narrative are minor structures within it. So when we transition to the next episode, you're going to get to understand what I'm trying to make you understand by saying we have major structure and then we have the minor structure, or what you can say we have the major trend and then the minor trend. Meaning we're going to talk about the multiple side to market structure. So this is what we have. So we have a downward market movement here. We've established that. Let's pull this out. You're going to clearly see that. So you can see this is the structure. This is the structure. The impulse, the pullback, the impulse, the pullback, the impulse, the pullback, the impulse, the pullback, the impulse. So a bearish what? Market condition. And what can you see? Price breaking what? Swing low. Continuously breaking what? Swing low. Swing low. Breaking what? Swing low. So what we can now see here is that price gave us this movement to the upside. So it means this is the last lower high point that was created that formed this what? Lower low. Price gave a pullback, creating a high, which is a lower high, but then it failed to continue bearish to break this to create a lower low. Price continued further to the upside, breaking our last high point that gave us this lower low points. And that is what we now call what? The change in character or market structure shift. We're going to look at that in the next episode. So it means that this is our low. Price has created for us what? A high, because this is the high point that is now above what? This lower high. And then what do we have? Do we have a valid pullback here? Yes, we have a valid pullback. Price gave us what? That pullback. So next again, what do we have? Price gave what? An impulse to the upside. So you can see this movement again to the upside here, creating a new high. Because you can see this candle wick high is higher than the previous candle wick high. So price created this, another what? Pullback. Price gave an impulse, created this, another what? Pullback. Price gave an impulse, created what? This high. So you can see this movement is still within this candle high and the low. And then now a dip to the downside, giving us what? The pullback. And then what happened again? Price transition again to the upside, creating this high. And then what happened again? A pullback. And then what we're going to see again is the continuation to the upside. So since this is the highest point, it means that the newly created high should break above this. So what that means is that this is our high. And now price created what? The pullback. And then what? A new high point. So you may ask, why not identifying all of this movement within this? So that is where we're going to understand what's major market structure and then the minor market structure. So let's map this out so that you can see. So it means price created this low points. All of these movements are minor structures because this is the valid high that created this. So this movement were all within this range, this and this. So it is this high that broke through this. And now we have what? A pullback. Price again push, because the wick, this candle wick is above this other previous candle wick. And then we have a pullback. A push, we have what? A pullback. A push, we have what? A pullback. A push to the upside that broke this. And then we have what? A pullback. A push to the upside that broke this high. And then we have what? A pullback. A push to the upside that broke what? This high. So why not say this is the push and then a pullback before this push? No, this push is still within the range of this high and this low. So this is the valid push because this is not the high that really broke this high points. So this is how you identify what's the market structure. This tells us that we are in a bullish market structure. So we're going to look at how to really identify a valid break of structure. But for now, I just want to show you how to identify a market condition, because here we really do not have a valid break of that structure. This candle wick volume is not above this previous candle wick. It is just the wick that is above this previous wick. But then I'm just showing you how you can identify the impulse, the corrective, which is the pullback, the impulse, the corrective, which is what? The pullback. So this is just a basic concept. So as we transition, we're going to look at more to the what? Market structure. So we've seen and identified the bearish market, and now we've identified what? The bullish market condition. So let's see where we can possibly see a range bound market movement. We can also possibly just make use of this, even though what we can see is we still have a trend within it. But what you can see is this is an impulse to the upside that broke this, price fell, impulse again that broke this. So this is not really a range bound market movement. So let's see if we can find any range bound market movements. Let me see so that I can use that to explain the range bound market condition. So yeah, I've seen this. So this is a range bound market condition. So what can you see? Price just created this movement, a push, a fall, a push, a fall, yeah, a push. So you can see it's not forming a trend. We just have price reacting at resistance, and then price reacting at what? Support. That came here, bounce off from this, drop to the downside, bounce off from this, went to the upside, bounce off from that, went to the downside, bounce off from it, went to the upside. So this is a sideways market. So guys, let's end this episode here. To the next episode come your way. Cheers and God bless you.